Hello, everyone. This is Adeal. I welcome you all in today's live webinar about Let's Chat Real Estate. And today we will be discussing a very interesting topic about how you actually figure out the right property. And even before you figure out the property, what's the real importance of doing some other steps beforehand, which is your actual strategy. So, wherever you're starting from, whether you are buying your first property asset or you're buying your first investment property or your home to live in, you always need to have a strategy for that. And because you have to be thinking into the future. So thank you very much for guys joining in. If you have any questions, if you have any feedback, please feel free to share. Put your thoughts into the comments. Let us know that you are here. Give us a wave, give us a hello. Let us know you are here. And if you're watching the recording, please do let us know as well about your feedback, what you think about it. And if you have any questions, please feel free to post because we run these webinars specifically for you and to answer any of your questions. So without delaying further, very quickly, I should have put that on the silent. My apologies. But anyways, so before, let me put that on silent for now. Okay, so before moving forward, I just wanted to give a quick disclaimer as we normally do. So, any information that we talk about today is purely generic in nature and does not take into account any of your specific or personal situation. So, please don't treat it as a financial or a personal advice. It is not a legal advice as well. Please ensure that you seek your independent professional advice before deciding to act on any information presented or discussed today. And the information that we share today may or may not be applicable to your personal circumstances because we are not across your personal situation. We are talking about generic stuff only. Okay, so the big news for today is, guys, the cash rate has been put on hold, which was as expected. I think that was the right decision made, even though you will see media headlines talking about, wow, there is 1 million people under the mortgage stress. And yes, the cost of living and even the mortgage is an issue, is a challenge for people. Their monthly bills have gone up in terms of the mortgage bills, which is the biggest bill that we talk about. It has gone up as well. But again, the thing is that uh, with the way the money, the savings that people have in their bank accounts, when you look at the reports from the ABS, when you look at the banks reports, the big four banks, the major banks, the data that they shared, like Westpac shared recently about the billions of dollars its account holders have in their savings. And that is a testament that people still have a lot of savings sitting over there, and they will do anything actually to protect their assets and their properties. So it's, yes, mortgage stress is there is no doubt about it, but any kind of downturn or market swinging in negative direction is very unlikely at this stage. And I think that decision from RBA, where they've kept the interest rate on hold at 4.35%, I think that cash rate decision is really vital, because any cash rate drop today may have given a false indication that the future meeting may also result in further reduction in cash rate. Because guess what, the cash rate will go down eventually, whether it happens in the next meeting or the one afterwards. No one exactly knows when, but we also need to be careful of the fact that it will never go back to that same 2% of interest rate scenario where the cash rate was sitting at 0.1. So it won't happen again, and any rate in the cash rate would be slow, it will be gradual, and people need to be aware that it does not go back to the the COVID scenario, not the pre-COVID scenario, but what was there at the time of COVID in 2021. So having said that, I think that was a very sane decision made by the RBA today. And moving on, our topic for today is how to find the right property, and that is very closely related to your strategy, what your strategy really is. So today I'm actually sharing the story of one of our clients who has been with us for the last 3 years now. I will share what exact kind of properties they've bought, what price points, what regions they have bought in, and how those properties have performed, and what were their circumstances when they started, and where do they stand right now. So I will share all of that with you. And thank you all so very much for all the people. We couldn't do the webinar last week. I took a break because of the birth of our newborn daughter. She's doing very, very well. So we couldn't do the webinar last week, but thank you very much for your wishes, for your congratulations, for all the heartfelt and very heartwarming wishes. Thank you so very much, guys. So yeah, we are back now, and now we'll be talking about that particular client that I was sharing with you about, and that will show you which type of property you need to target in which kind of scenario. That's absolutely critical, right? So the most important thing that people miss out on, they don't have a strategy. They don't know what they want to buy because they don't know what they want to achieve out of it. So strategy is simply asking yourself, what do I want to achieve from this purchase? That's the simple question you need to ask yourself. If you don't have the answer for that, consult with your wife, consult with your husband, consult with your partner. If you still don't have an answer to that, consult with the people around you who have done something similar before. If you are looking to build a property portfolio, don't ask someone who is sitting on their first property and haven't been able to buy anything after that, because they haven't done something that you are seeking advice from, right? So if they have done something, they've already got 2, 3, 4 properties, they have built a portfolio, and they are the people you should be seeking advice from. So please be careful with that. Yes, your friends and family have your best interest at heart. They really love you, they really care for you, there is no doubt about it. But the problem is, if they haven't done something themselves, then all the advice they will give you will be based on their fears, their apprehensions, not actually on their experience, because they haven't experienced that, right? So please seek input from people who are experienced in what you want to do as well. So that's where the strategy is important. Without further delay, I'll quickly dive into this story. So this lady, who is a single mom, she was divorced in late 2021. After the process of divorce, she got her settlement funds in early 2022, which was like close to 3 years ago now. And she had a son after that. She was still working. She was doing a very good job of 140 grand, which also helped her with the loans, as I will show you. But she also got a settlement amount of around $320,000. Now, with that settlement figure, because of the divorce, she had different options. Her main dream was to actually have a home for her son, where they have her own property, which is fully paid outright. And at that time, she was actually living in a townhouse in the northern suburbs of Melbourne. So it was a small 3x1 townhouse, an older style townhouse, which she was living in, but she wanted to live in the western suburbs of Melbourne. And the property she wanted to buy was around 750, 800K in the suburb called Williams Landing. Now, it's a very desirable suburb in west of Melbourne. For people who are from Melbourne, it is one of the desirable suburbs on the western sides of Melbourne. And at that point, the price point was around 750, 800K. And she wanted to buy that. Now, if you have $320,000 in your bank account, buying a property worth 750, 800K is very, very easy, especially if you have a stable job of 130, 140 grand. So a normal person would simply go out there, make an offer on a property, put down 20% deposit, buy that property. But for the next 30 years, what they imagine to be their dream home, for the next 30 years, they will just keep paying mortgage on that. And by the end of 30 years, once they have finished paying mortgage, they will be close to retiring, which was very true for this woman as well. She would be close to retiring probably in 2051, 2052. Her mortgage would be finishing by then, but then she will have a house which is fully paid off, but nothing to show for any income after that. Because guess what? Once you retire, you need money to survive. The average age in Australia is around 84, 85, and you retire at the age of 60, 65 roughly. So for the next 20, 25 years, from 60 onwards up to 85 years of age, you need to have some stable source of income. You can't just rely on pension, right? So once we first met with that lady, that was the exact discussion we had. And I told her, well, you have two options straight away. You can actually go and buy a house, really nice house for under 800K, and just pay a mortgage on it for the next 30 years. You will feel that you have achieved your dream. But on the other side, I would suggest that you actually multiply these savings. So that 320 grand that you have, you actually use it and you multiply it and create more wealth out of it. And use that to strategically create more wealth, and use that wealth to actually buy a home which is already fully paid off in the next 10 to 12 years. And initially, she was really apprehensive of the idea. She thought this is some scam, this is some kind of thing that will actually rip her off. And she was not really clear on that. So I sat down with her, I laid down the strategy, and that's the exact strategy I'm going to show you now. So, guys, if you're tuning in, please leave us your comments and your questions, and we would love to take them on. So, this lady, we decided to go and we managed to convince her to actually invest rather than buy her own home and just pay the mortgage for the next 30 years, because she already had a house where she was living in. It was her own property, it was a townhouse. She was paying mortgage on that. There was not much mortgage remaining on that, but she was still paying a mortgage. And we said, let's not worry about this property, just keep it over there, but instead make your savings work harder for yourself. So what we did was, let's deep dive very, very quickly. We helped her create a plan where we said, let's buy 3 properties over the next couple of years. She was starting with a good deposit. 320 grand is a good amount of money to have, right? Not everyone has that. We understand that. But if you already own a property where you have some equity sitting in there, if you're living in Sydney or Melbourne, your home is already $1.52 million, $2.5 million. You have some equity in there, and you can use that equity to do something what I'm about to share with you, with what this lady actually did. So what she did was, if you can see the numbers, the first property we helped her buy was in Perth. It was in March 2022. I will run the numbers very, very quickly. We used around 80,000 deposit from that 320 grand that she had. We bought something for $405,000. Now, the important thing with that property is that property was bought in a growing region. It was not a brand new region, but that was an area which was already established for the last 10-15 years, but the demand was rising really fast. There was a lot of infrastructure coming in, a lot of government spending was coming in, but the supply of new houses was actually dropping. So because of all the infrastructure coming in, there were more people coming in because there were more jobs. People wanted to live over there. They wanted to rent over there. The days on market was dropping. People really wanted to live over there. They wanted to buy properties over there, which was driving the prices higher. But the council was still lagging behind. So the council planning in terms of residential development was still quite slow, which means the supply for the next 2 to 5 years was really trending lower and lower, but the demand was rising. So what that meant was there was a supply and demand imbalance. The demand was rising continuously, quarter after quarter, year after year, but the supply was not catching up. And because the supply was not catching up, the demand was rising. That was the perfect suburb where you could get some really good capital growth in the first 3 to 5 years. And that is what exactly happened. Now, in this purchase, in 2.5 years or so, this property has already grown up to around $645,000-$650,000. So from 405, it has gone up to 650, 645 easily if she wants to sell it today. And she has already made around 230 to 240 grand on this property by now. Over the next 10 years, 11 years, by 2035, this property will give her an equity of easily around 600K, this one single purchase. Okay, so that is just one thing over here. Yes, this property has a bit of a negative gearing. She's paying around $120 from her pocket because the rental income which is coming in, which is like $550 per week, quite healthy for a 400K purchase. That 550 is not able to sustain her mortgage and council rates completely. So she still has to contribute like 5 or 6 grand every year for this particular property. But in return, her property has given her around $240,000-$250,000 already, right, in growth. Now, I'm not talking about a townhouse here. I'm not talking about an apartment. I'm talking about a standalone house. This was a 4-bed, 2-bath house that was bought for 405 grand in Perth back in 2022. Now, fast forward, this was the first purchase we did. 3 months after this purchase, we helped her buy the second property because remember, she's starting with a total cash savings of $320,000. So we have only used 80 grand on the first one. Now we are on to the second purchase where we utilized around 70 grand deposit, and this time we took her into Adelaide. Now that was the time where Adelaide was the real place to buy. So once we got into Adelaide, we bought something in June 2022, again a standalone house, a 3-bed, 2-bath house. And that particular property was bought for around $388,000 after some negotiations. And that also had provision to build a granny flat on it. So just imagine that was a lot of 700 square meter. We bought it for around $388,000. You can't even imagine getting something in Adelaide for that price now. That property is currently sitting easily. That is made at 530, 540K is the price point where it is sitting right now. And it has already helped her made 150, 160K on a conservative note. Now, that property was not exactly in Adelaide, but it was in a regional center of Adelaide, like 1.5 hour away from Adelaide CBD. But the good part, again, the topic, I'm not going away from my topic. I still remember what we are discussing. So the idea is that we have to buy properties which work for us. Now, this property, the reason it was working was it was supported, the region where this property was located was supported by local economy. And when I say local economy, it was supported by local refineries, it was supported by local government jobs, it had a major hospital in there, it had major medical facilities in addition to that hospital. What that meant was that the employment sector or the economic sector was really, really stable, which meant that it was not a regional town in the middle of nowhere. It was not like a mining town. A lot of people have that myth that if you buy in regional, you're buying in a mining town. That's not true. Not all regional towns are mining towns in Australia. The good thing with this was it had its own local economy, own local population of around 60,000 residents. And that was the reason that there was a demand for people to live over there. There was secondary schools, there were high schools, there were tertiary education centers, there were own universities in there. They still have a couple of universities in that area, which meant people wanted to live over there. They wanted to raise their family over there. So when you're looking to buy properties, even in regional centers, those are the things you have to look at. Look at areas where you have good medical facilities, good educational facilities, good diverse local economy. That is absolutely critical. You don't have to buy in an area where there's only agriculture happening. You don't have to buy in areas where there's only farming or only mining which is happening. You have to buy in diverse economic regions, and this is one of those regions as well. So this is the growth that has happened on this property up until now. And just going back very quickly, so this has already made like 150 grand, and it can easily make between 500 to 600K by 2035. Once again slightly negatively geared, but again, she can afford to do that, and she can afford to pay that 170 per week from her pocket, and most of that money comes back actually via tax returns as well. So that's the good part about it, right? So I'll talk about the tax side of it in a minute as well. Second property was this. The third property we helped her purchase in regional Queensland. Now at this point her borrowing capacity was really getting exhausted, so we wanted to buy something which helped her buy her fourth property later on. She hasn't gone up to fourth property yet, but we are already thinking about it. So what we bought now was a dual occupancy. By dual occupancy, I mean it has two rental incomes coming through, which means the rental income is now high. That higher income will actually help offset her expenses and also help her borrow more money for her fourth purchase, which we'll be doing in a couple of years' time. So that is where we bought a dual occupancy property right now. Now with this dual occupancy, the budget was slightly higher, around 530K. So we had to 512K actually for this one. We required a higher deposit. We went with 130 grand. That includes her deposit, her stamp duty, even our fees as well that we charge her. That is also included in there. And that property is renting for 750 a week. So the main house and the granny both, because it's a dual occupancy, they both are renting for 750 a week combined, which is like close to 7% of rental yield. And again, not just the rental yield is high, but the growth and the demand is also high. Now, one of the major reasons for this particular property was this was very, very close to two major hospitals. One of the hospital in that area where we bought this in regional Queensland has gone through a recent expansion, and it has gone through like 150, 160 million dollar expansion. And we knew that expansion is coming up. Now, because of that expansion, there has been a surge of jobs. At least 350 to 400 additional jobs have been created in that particular hospital because of the expansion. Now, because the jobs have been created, that attracts educated doctors, midwives, nurses to live in that suburb around that hospital. So because we knew that expansion is coming, and if you know that any hospital is having an expansion, try to buy something close to that hospital. Again, don't pay over the market value. Make sure that you buy at the market value. That is also important, but try to buy close to it. If you're buying close to a hospital, one more important consideration, hospitals are located on main roads, and main roads are busy because hospitals need good fast access. So try to avoid buying exactly on the main road, because that is where you will struggle to rent your property. And also, people don't want to live in properties with this noise coming of sirens and ambulances running all the time. So buying close to a hospital means buying within like 500 meters, within 800 meters to a hospital, which is like 10-minute walk, 15-minute walk, or a 2-3 minute drive. That is what I'm suggesting. But don't buy like 100 meters from a hospital, because you will struggle to rent that out, and you will probably buy on a busy road as well. So that is another tip. When you're buying a property, that is the kind of property you should be targeting. So with this client, because this property was close to a major hospital expansion, it had high growth, it has been consistently renting out both the units, the front house and the granny as well. It has been consistently rented, and the tenant quality is also good. Like, there are medical professionals who are renting it out, there are nurses who are renting it out, and they are happy to pay the market rent. They don't spoil your property, they are maintaining it well as well. So that is another plus factor. Again, with the forecast on this one, I'll just change the view a little bit very quickly, because I don't see, yes. So with this one, I couldn't see my own slides over here. So again, the purchase price was around 512, but it is forecasted to grow at least by 600 to 700k in value. That is the additional growth that it will have in total. So the purchase price was 512, but it is expected to be around 1.1, 1.2 mil by 2035. And the rental growth will also happen. So the rental will not sit at 750, that will also keep growing. Now, if we summarize these three properties that we bought for this particular client, and summarize what they've achieved so far. So essentially, they started with a deposit of 320 grand. We made them split that across three different properties to have more growth, to invest and make use of multiple markets across the country. Don't just put all their eggs in one basket, and enjoy the growth in all different states at different points of time. And they listen to our advice. And the good thing is that using that 320 grand, in less than 3 years, they have already created real wealth of $538,000. That is more than $500,000 that they have created already. In that process, yes, it was negatively geared, because they had to pay. The interest rates have been sitting. They started rising from 2%. They went up to 6.5% now on average. So yes, the lady has paid around $45,000 from her pocket in that time period across all the properties. So for three properties combined, she has paid around $45,000 as outgoing expenses, because the rental income has not been able to cover all the expenses. But the good part is, because she was buying the right property assets in the right locations, which were renting out very, very well, even though she was slightly negatively geared, that $45,000 she paid from her pocket has helped her make more than $500,000. That's the key over here. And because most of those expenses are tax deductible as well, so she will probably get $18,000-$19,000 already. She has already gotten most of it already, but around $18,000 to $19,000 of that comes back via cashback. So essentially, she has only spent like 25 grand if you check the net cash flow from her pocket. So spending 25 grand, getting $500,000 back, that's not a bad proposition in my view. What's the plan moving forward? So again, the plan, if you remember from the start, was that she wants to have a fully paid off house. She wants to buy a house which is fully paid off in Williams Landing. And by the time she buys in 2035, the market would have gone up. So now she will have a couple of options. But before 2035, she will be in a position to buy two more assets, because she has like $500,000 equity already sitting there. So in a couple of years, when her income rises, when the interest rates start coming down, she will be able to borrow more money. At this point, she is maxed out with her borrowing. Once she is able to borrow more money, she will be able to buy two more properties, one in 2027, other in 2030. And the best part is that for those purchases, she will not require a single dollar from her pocket. All that equity she has already made, she will be using that particular equity to buy the fourth and the fifth investment, right? And with the combined 5 properties, by 2035, she is expected to have two of the options. Either she can actually sell all of them, pay capital gains tax on them, and then buy a house in Williams Landing, which by that time will be around $2 to $2.2 million roughly. But that will be fully paid off, and that will be paid off in 10 years, 11 years time, not in 30 years time, right? So she started the journey in 22. If she buys in 2035, that's like 13 years, 12, 13 years. So in 12, 13 years, she has achieved what she would have achieved in 30 years, right? So that's how she has fast tracked the entire process. Instead of buying the house first, she has actually, and living in that house, she has gone and bought investments and used those investments to buy that house later on. So that's exactly what she has done. The other thing she can do is, if her plan changes, if she does not want to buy that house anymore, if she wants to continue living in her townhouse in northern Melbourne, where she's currently living, northern suburbs of Melbourne, then what she can also do is she can sell 3 of those 5 properties, use the gains of those properties, the growth that has happened, to pay down the capital gains tax, and also pay down the loan on the 2 remaining investments. And if she goes with that approach, then by 2035 we can very safely forecast that she will be having 2 investment properties fully paid off by 2035, which is like 11 years from now, and that will deliver her rental income of anywhere from 120 even up to 130, $135,000 every single year. Because if you buy in the right locations, not just the values go up, not just the property prices rise, but it's also the rental income that goes up as well. So she will have those options and she can decide whatever she likes. So I just wanted to share this with you guys. If you have any questions around it, please feel free to share your thoughts. Thank you very much, Edward, for joining. Thank you very much, Margaret, for your support. Thank you very much, Shaba, Avril. Thank you for your comments as well, guys. And if you're watching the recording, please share your feedback. Let us know your thoughts. Let us know what you want to, what you want us to talk about, and we will definitely be discussing that. Last but not the least, so this is the deal of the week. So this is one of the purchases we did a couple of weeks ago, and that purchase is like for an owner occupied client, 5-bed 2-bath house, really nice purchase, and that was bought at an auction. So just wanted to share this one as well. This was done in the eastern suburbs of Melbourne. So I thought just to share it with you guys. This was one of our very recent purchases as well. Again, if you have any questions, feel free to reach out, please. Let us know your feedback, what your thoughts are, and I would see you next week. Until then, have a very good night and stay safe.